This is TreppWire Week in Review for week ending January 20th, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with our experts, Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, the federal government hit the legal debt ceiling, and investors had a slew of new data to dissect as earnings season got underway. Wholesale prices dropped sharply last month. Retail sales fell more than expected. Manufacturing activity from two regions indicated contraction, and housing data was mixed as home builder sentiment rose for the first time in a year, while housing starts dropped. Manus, with all of that, we had another round of Fedspeaks for investors to digest as well.
Well, certainly the market spoke and spoke loudly this week. I looked at the data and parsed it pretty thoroughly during the week, and I would say it was a mixed bag. On the things that were positive, you referred to the builder sentiment, even though that's at really a low level historically. They did see a strong bounce this month, and it came in above expectations. We saw the highest copper prices in about 8 or 9 months, which is indicative of people building and spending. And we saw PPI come in much more muted than people would have or expectations had been. So much cooler than expected. So all of that, when you put that together, you're thinking that's the kind of thing that investors would cheer, that they would say, okay, maybe this supports the Fed taking their foot off the gas. Maybe this supports the economy bouncing back in terms of new homes being constructed and so forth. But investors were hearing none of that. They wanted nothing to do with this. All they heard was hawkish remarks from several Fed presidents, disappointing retail sales, and a challenging global economic market, right? We see a lot of turbulence in Japan, and then in the US, we see fighting over the debt ceiling. So in a week where I would have said it was a mixed green in terms of economic activity, the investors saw nothing but storm clouds brewing. The result was several days of sizable stock market losses. I think the Dow was down 1,200 points or so, give or take, over the last 3 sessions. And bond yields really tumbled, right? When you see bond yields tumbling and the 10-year now below 3.4% and the 2-year at about 4%, right? Remember, it was up around 4.8% at one point. That is indicative of investor sentiment that's saying the economy is slowing, it's slowing sharply, and this may be a harder landing than we were thinking about 2 weeks ago.
Yeah, I think if we just break down some of the stuff you talked through there, Manus, I mean, these are some pretty big headline-worthy comments. Janet Yellen this week said that her department began using extraordinary measures on Thursday due to the federal government hitting its ceiling for borrowing. You know, I know we've had this song and dance here around the debt ceiling a couple of times, you know, in the recent history, but I don't think we've had this type of challenge given the current macro environment from the economic perspective. So, you know, a government shutdown now could really have some ripple effects that maybe we wouldn't have felt the last time this happened. So it'll be interesting to see, you know, how seriously, you know, both Democrats and Republicans look at, you know, trying to find a reasonable solution to get this done in an expeditious fashion. You mentioned retail sales. They were down 1.1% in December, which was slightly more than the 1% that was forecast. And if we look at the categories, gas sales at service stations were down almost 5%. They were down 4.6%. Department store sales reported a decline of 6.6%. Online sales were down 1.1%. Furniture and home furnishings 2.5% down, and vehicle and parts dealers saw a 1.2% decrease. So, you know, I think these numbers reflect slowing of inflation, cooler consumer demand. But if you look at it year over year, retail sales are still up 6%, or were up 6%. You talked a little bit about home builder confidence. And just to provide some context for your comment there in terms of the sentiment rising, the sentiment was at 35%. If you look at this a year ago, it was at 83%. So when you're, you know, basically at zero, doesn't take a whole lot to show positive signs there. I think on the whole, still not great news. And if you look at some of the home builder stuff and the starts, you know, it looks like new home starts in December dropped about 1.4%. And so, you know, more bad news potentially for home builders, compared to what we've seen over the last couple of months. We talked last week about KB Homes with a really high cancellation rate on their new construction properties. So maybe bright spot for the mortgage industry, there was a slight increase or gain in mortgage applications last week. I think Martha maybe mentioned this last week. Some builders are starting to offer some really low interest rates for home buyers. So just to give some context there, in California, Pacific Point communities, on their 4-bedroom homes, they're offering a mortgage as low as 2.75% on an introductory basis. And then here in Texas, Pulte Homes, they're offering 30-year fixed rate mortgages at 4.25%. For their homes that are 3 to 5 bedrooms. So maybe a little gimmicky, but hopefully for the builders, it does stimulate some of those buyers and gets them off the sideline.
Yeah, it would be interesting. I don't know if you have this data point, Lonnie, or not. Are these introductory rates similar to what they had in 2006 and 2007? Are they teaser rates, or are these permanent, 3% and 4%, 15 or 30-year fixed?
Yeah, so on the Pulte, it does appear that that's for the full 30-year fixed rate at 4.25. So they must have, been proactive and maybe hedged on the front end so they could offer that now. On the Pacific Point communities, it doesn't say, other than it says that they're offering a mortgage rate as low as. So I would assume at 2.75, that has to be some sort of an introductory rate or a teaser rate. I did see, some commercials on TV over the last couple of weeks offering introductory rates, and basically they're giving the buyer an option that, at some specified time, maybe 36 months or 48 months to refinance at no cost. So I think the lenders are hoping to maybe bridge that gap between where rates are now and where they hope they'll be, at some point in the near future.
Well, we had a spirited conversation last night. I believe I've mentioned this before, that I started teaching in the evenings at Clemson University down in South Carolina. And we were talking about mortgage finance last night and floating rate mortgages. And I brought up the idea of teaser rates. And my analogy for that, I'm sure you guys have all seen it. You see the sports betting analogies, or not analogies, come-ons, if you will, every single day, where it's bet $5. And if Steph Curry has 4 points tonight, you'll win $200, right? It's trying to lure somebody in, buying them in, to start becoming a habitual gambler on their site. And I really, I disdain that business model, and I think it's corrupting. It's like selling cigarettes to, preteens. But that's what the teaser rate is. I was trying to tell my students that, back in 2007, you get this thing which says, for the first 2 years, your rate is 1.7%. You don't read the fine print, and then 2 years later, it jumps up to 4.5%. And my point was, if somebody ever offers you that, run fast, right? Because if you don't really do your homework, it's the kind of thing that can really backfire on you. Just like this gambling stuff, right? If once you're sucked in and you're no longer going out and playing baseball, you're betting on baseball, and that it's a toxic cycle.
Wait till they hear about graduated mortgage payment and or negative amortization loans on some of these alternative financing mechanisms that people use to try to get you in the door. Just as an aside, but I think relevant here, if you look at interest rates on credit cards, it looks like the average interest rate on bank issued credit cards is just over 19% in the fourth quarter of 22. Delinquencies are still low, but interest rates are high. So teaser rates on the front end of a home mortgage coupled with maybe 19% interest on a credit card means you're probably going to be working for a really long time if you're in that spot.
Yeah, before we move on, before Martha takes us to the next segment, I just wanted to talk about two other things, right? We cannot isolate the market moves today and this week by subtracting out Japan and the debt ceiling crisis, right? As part of the narrative, and how much that impacted the tone of the market, the sell-off, and the drop in interest rates, we'll never know. But I wanted to put both things in perspective. On number one, on the debt ceiling conversation, when we went through this the last time, which I guess was 2011, 2012, it was during the Obama term, it did lead to a lot of volatility in the markets. And while I don't think that this should impact the day-to-day life of the average American, and I think most people probably sit back and think, don't you have anything better to do than to fight about this? Can't you come to a solution that allows you to focus on more important things on the economy or the environment or education. But nonetheless, if this persists, we will see a lot more volatility over time. With regard to Japan, I'll try to pull the onion back here a little bit. What we're seeing here is a fight between bond investors and the Japanese government. The Japanese government is trying to hold interest rates incredibly low by buying as much inventory of bonds as they can. Just like the US Treasury bought bonds for the last 3 years, Japan has been doing that, the Japanese government or the Japanese central bank on steroids. But they don't buy everything. And bond investors in Japanese sovereign debt are expecting higher yields than what the government is trying to maintain. And so there's a yin and yang going on right now where people are wondering every day, are interest rates in Japan going to explode higher, and what would the impact be on that? And I think there's a great possibility that we'll see higher rates in Japan, although I'm not expecting that to lead to great turmoil here in the US. I think in the past, Japanese investors had been huge investors in US CRE, CLOs, US corporate CLOs, and other debt. They have pared that back considerably over the years. And I would also say that the carry trade, the idea of borrowing in yen and investing in foreign currencies, is not nearly as big with hedge funds as it was 10 years ago. So while Japanese yields could go up and there could be a pullout of other markets, people taking their money out of US markets and European markets, putting it back in Japan, my early read on this is it's not systemic in nature, right? I could be wrong here. A hedge fund could blow up somewhere, but my gut tells me after talking to traders, money managers, hedge fund guys, it doesn't look like that right now.
And another news point that we've been watching this week, big bank earnings reported. And there were some big themes that came out across the board with all of the bank performance.
Yeah, on the big bank earnings, it was a bad quarter for deal making. There seemed to be an across the board drop in investment banking fees, which hurt performance, and increases on the money set aside requirements for expected defaults. So kind of a triple whammy for them in terms of negative outlook. So if you look at the banks bank by bank, Goldman's profit fell 66%. Morgan Stanley profit fell 40%. They were down significantly. If you break them down by sector, it looks like Goldman had operating expenses really hold them back. They rose to 11% to just over $8 billion. They had to post a $972 million provision for credit losses in the quarter. That was significantly higher than the $344 million a year ago. Not great news there. If you want to find some silver lining, JP Morgan saw their profit rise 6%, revenue jumped 18%. So in this instance, their revenue actually topped expectations as interest income at the bank was up about 48% on higher rates. This prompted CEO Jamie Dimon to basically walk back his economic hurricane discussion that we were all familiar with last year, to basically saying now he's projecting maybe a mild recession. If you look at Bank of America, profit was up 2%, revenue was up 11%. And Citigroup, revenue rose 6%, but profit fell 21%. Still a beat on expectations, though. So kind of a mixed bag here in terms of results. I think we're seeing the headwinds of the current economic environment playing out here with the bank reporting earnings. We have a couple of other consumer good companies to report. See how that plays out the rest of this month.
Got two thoughts on those numbers that you threw out there, Lonnie. Thought number one is, the first half of this year is going to be very hard for banks to make money. On the revenue side of things, nobody is expecting a rash of IPOs or bond issuance, certainly not with rates where they are right now. That will continue to eat into deal-making revenue. It will keep them from making fees on loan originations, on securitizations, issuance, et cetera. So that is one big headwind. Volatility may allow them to make some money on trading. That's a potential slight headwind, but there's only so many banks that really do extensive trading, right? Most large regionals don't do that. And you have to think that their cost of funding what they're paying to depositors for CDs and other things has to be catching up to them now. Banks are often very slow to raise the rate that they pay you for your deposits. That has to be narrowing at this point. So those are the headwinds that banks are facing. The silver lining, to use your term, is that I think sentiment for banks is so low right now and expectations are so low that it doesn't take much to give the stock a bump. In fact, if you look at the stock market today, among the biggest market movers today, Comerica, M&T, and Truist, all considerably higher today among the leaders today. And I think that that's because expectations have been so dimmed for the banks over the last 3 or 4 months that any beat is a good beat.
One point I think that we'll want to watch, especially since Lonnie mentioned the interest rate on credit cards, is a note that came from Goldman's CFO. The bank is seeing early signs of consumer credit deterioration as the economy slows and more borrowers at risk of falling behind on payments. So that's concerning, especially in certain sectors, and obviously tied to some of the other things we've talked about in retail and some other property types.
Yeah, it's kind of sad to see these things. Lonnie brought up the near 20% rate before. And I know that, they talk about these institutions that do kind of end of week lending, right? They lend on, the future check that a guy's going to get, a day laborer or something like that, being sometimes 30% or something like that. And, the combination of lack of sophistication among young people in the workforce, people that are day laborers, waiters, waitresses, the whole thing, combined with the higher costs of housing and food, really squeezes people in that part of the economic strata much harder than most. And so they're not my students, but anything that can keep people from racking up larger debts is a public service message I'm happy to give. That's that 19% rate. It's very difficult to dig your way out of that once you start building up sizable balances.
I saw today on Twitter, the average car payment, I think, was like almost $800 a month, like $777 a month. You start talking about interest rates on credit cards and car payments at almost $800 a month. Couple that with what's a dozen eggs cost now, like $10. Talk about that in real time. Like, it definitely has a negative impact for a lot of consumers out there.
Well, I've joked in the past about my own frugalness, and it's half joke, half true. But if that's my case with going to buy a new car, I'm going in with the idea of, I don't need a paint job, I don't need air conditioning, I don't need FM radio, and I'm willing to roll down the windows myself.
And of course, we saw another tech company announce layoffs. Microsoft, which had been one of the companies that hadn't yet made the list of companies that had massive layoffs, joined the list. And now I think Apple's the only one left that has not yet made an announcement of layoffs.
Yeah, so this was a pretty significant one. I mean, as a percentage of their total workforce, maybe not as much, but they said they're going to lay off 10,000 workers. I think Microsoft employs about 220,000 workers. That was according to some data at the end of June. So it's less than 5% of its global workforce, but it's still impactful. And I think it fits the narrative that you were talking about, Martha, in terms of, it's kind of the latest tech company domino to fall. An interesting stat here, this was from Business Insider. They said only 15 days into 2023, and on average, about 1,600 tech workers per day have been laid off. And so it'll be very interesting to see if that trend continues to hold. But, we've talked about it. This started, several months ago, and it seemed somewhat anecdotal at the time. But at this point, if you go down the list of major tech companies, almost all of them have had some form of layoff. And this is just another, negative headline for the tech sector.
Moving on to retail news, we saw retailer Party City file for bankruptcy protection.
Yeah, I think Party City is not everywhere in the U.S. You don't see many of them in the South. I'm not sure if they're big in Texas, Lonnie, but up here in the Northeast, they're plentiful. They tend to run in parcels of 10 to 15,000 square feet. They are, kind of in that Best Buy, Bed Bath & Beyond size. When you see a mall, that's the kind of square footage 10 to 15,000 square feet would be. They operate a lot of stores, hundreds and hundreds of stores. Our team yesterday, our crack research and analytics team yesterday, put together a list of Party City or CMBS loans where Party City is listed as top 5 tenant, and it's dozens. I think it's close to 100 loans that Party City is a tenant in. And now that they're in the bankruptcy window, they have that ability to reject leases. We haven't seen much of this in the last couple of years, big bankruptcies by retailers. This is the first in a while of size, but it will weigh on that small to medium-sized shopping center that through the last 2 years has done really well. And for Lonnie, you looking for that Halloween costume in October next year, that 2-person horse costume that you like to roll out every year, you're not going to be able to use Party City. You're going to have to go to Halloween Spirit, one of those pop-up stores.
Oh, I think Halloween Spirit's licking their chops because they just got about 800 new stores they can pop up in. So, they do have a pretty large presence here in Texas, but I'll say I think the number one use case for them is basically just getting your balloons filled up. And so when there was a helium shortage, and that's your primary driver for foot traffic, that's a double whammy that you can't overcome, as evidenced here. I think this just speaks to, we've talked about this coming out of the pandemic. Good retail survived, bad retail maybe hasn't. And I think the Bed Bath & Beyond story, the Party City story, these are aging retailers that haven't really been able to adapt to the new environment. They haven't created an omni, channel presence with their footprint, their delivery, their marketing. And I think, we're going to see these types of stores continue to struggle. Maybe the upside here, though, is that they can divide those storefronts into some smaller footprint stores and get some of these, more tech-infused retailers in there that makes those centers actually more viable heading into the future.
Well, you brought up Halloween Spirit, and for those that don't have it in their area, they do pop up around the Halloween time. They take short-term leases, 2 or 3 months, and then disappear. I agree with Lonnie 100% that they're now looking at all these Party Cities as potential landing spots. But Party City itself pointed out that Halloween Spirit had crushed them. I think Party City made an awful lot of their money around the Halloween time, selling costumes and Halloween decorations and the like. And the new player, Halloween Spirit, really took a lot of their margin away. And they pointed out to that as part of the reason for their demise.
And in our Digging for Data segment, which we haven't done in some time, we're going to talk about sales transaction data. We've heard a number of people that we've talked to comment on how price discovery right now is the focus for investors and market participants. So our own Trepp Insights dashboard is something we're going to talk about, and some of the data that we pulled for the month of December showing the number of transactions decreasing no less than 78% across the board, all property sectors, but average sales price per square foot increased in 3 property types.
Yeah, so I think we had this one on the shelf for a little while because we couldn't afford to fill the construction crane up with gas. But now that gas prices have come down a little bit, we're firing it back up. So I think you highlighted there, Martha. I mean, 78% drop across the board on sales transactions. And if you look at, these by sector, it's interesting. Multifamily saw a significant decrease month to month, about an 80% decline. But the average sales price per unit was up about 44% in our data. So this is a national representation, which you guys have heard me say before, no such thing as a national real estate market. But when we're looking at this holistically, on average nationally, multifamily price per unit went from $208,000 to just over $300,000 per unit. If you look at retail transactions, they also were down about 80% from the previous month, but average sales price per foot increased about 18%. They went from $292 a foot to $343 a foot. And then lodging transactions were also down about 80% from the previous month. Average sales price per unit increased by 72% though. So this, $181,000 a key to $312,000. So I think we've had a couple of large, really large resort style hotels that sold that probably skew that number up some, but it does show, you can't just look at the headlines and say there's been no transactions or the market's, sky's falling. Yeah, their transaction volume is clearly down, but deals that are getting done in some instances are actually getting done at a higher price point than what we've seen in the previous month. So I think it just speaks to the fact that real estate is local, sometimes hyper local in nature, and depending on the asset, even in a market like this, good assets will still trade. Investors are looking for yield and they're looking for cash flow. And in an instance where a property can provide those, I think there's still active buyers and there's still money available for those deals.
Yeah, I think that, to sound like a broken record, something I've said for months and months, my prediction of a shallow trough in what some people think might be a bumpier or harder landing is really driven by everything you just said, Lonnie. The fact that, unlike in 2008 and 2009, where the arteries were completely clogged and nothing was trading, we do see still a steady stream of property types selling across almost all markets at this point, whether that's a geographic market or property type market. And that gives me confidence that, the economy will muddle through, unlike it did, in 2008 to 2010, where it was really beyond hard, right? We slammed into the ground and head first. So those are all good signs. And I think that, if you want to learn more about this, you should definitely reach out to Lonnie. He'd love to show you some of our statistics.
And office obviously has been talked about as the property sector to watch. And we have put together a report. Manis and team have actually rounded up a list of office loans that we're going to be watching closely across the U.S. market in 2023. And we've created this report that has probably about 20 odd or so loans with a skinny on why these are on our radar.
Yes, what we tried to do was take something that was, I was looking for the word before, we've curated. It's like people curated a playlist or curated a, museum, display or something like that. We've curated a list of loans that, for one reason or another, have popped up on our radar. We tried to give pretty wide geographic distribution of this. I've said many times before, there's one or two loans in really every city that you can consider a real loan of concern. Some cities have more than that. So by no means is this everything, but it is an accumulation of things that we've written about. The one thing that I would take away from this, and if I can do a shameless plug for this, is that via our TreppWire research and our podcast, a lot of this stuff doesn't hit the rocks in terms of a loan missing a balloon date, going to special servicing, becoming delinquent for the first time until 2 or 3 years after we first talked about it. And so a lot of these loans on there, even though they're on there, we're watching them because their maturity date is looming. We've known about them for a long period of time. There's one in Charlotte that we'll be writing about in tomorrow's TreppWire. It's in the report itself, but at 301 College Street in 2019, the rumor started that Wells Fargo was going to give back 700,000 square feet. Well, that loan this month went to special servicing and is facing a May 2023 maturity date. So I guess it's a long and roundabout way of me saying that if you're waiting for servicer data to inform you about bonds to trade out of, opportunities to get into, you're not doing enough of your homework. The clues are out there for you long before the data catches up with it. Even when it comes to leases, a lot of times you'll know long before a lease expiration date that a firm is moving from one part of the city to another. And it's just kind of my gratuitous way of saying that if you're not doing that now, you're probably missing out on either distressed purchasing opportunities or ways to get better returns on your bonds by missing landmines.
So let's dig into some of the stories we've covered this week. And we're going to start in Seattle, which has a number of stories that came out that were all, I would say, definitely on the bad side.
Yeah, it was all Seattle, all bad this week. I'll run through them very quickly. The first one from Alex Halverson of the Puget Sound Business Journal. He reported that Microsoft is going to move operations out of even more Seattle area offices. They had already announced that they were going to give up space at the Advana Office Commons and 90 East Sammamish Park, as well as Lincoln Square North. Together, those spaces totaled several 100,000 square feet. Those were already baked in. This week, they announced that they will not be renewing 560,000 square feet at City Center Plaza. So all across that, you're probably talking about, I don't know, 1 million to 1.5 million, 1.5 million square feet in Seattle just from one firm. It doesn't get any better. In the Seattle Times, this comes from Paul Roberts. Late last week, Facebook announced that it was going to try to sublease offices at Arbor Block 333 on 8th Avenue in downtown Seattle and at Block 6 in the Spring District of Bellevue. It's unclear exactly how much they're putting out there, but I have to think that's another several 100,000 square feet being put out for sublet. And then on the retail side, Nike said that they are exiting downtown Seattle. They have 25,000 square feet of street level retail in a Nike Town store in Seattle, and they will be vacating that as well. So, when you take this all together and you add on top of the fact that Amazon a few months ago said that they were going to pull the plug on a new development in that city, that's a lot of excess space that will have to be absorbed. And I don't know where that absorption comes from.
Yeah, it's really, you mentioned the Amazon, they basically paused construction on 5 towers in downtown Bellevue and, put plans for a 6th building on ice. And I think, because they're just a little bit concerned about your last question there, Manus, in terms of absorption, utility, et cetera. If you look at some of the macro here, Seattle has an inflation rate of about 8.4% right now, which is 3rd highest in the nation. That was only behind Miami and Phoenix. Obviously, Miami's probably handling that a little bit better than the others, just in terms of where they have their international destination, F1 race, or some things there that brings, some wealth into the city. I think Seattle's been really reliant on Microsoft and Amazon. I mean, those are the 2 largest private sector employers in the city. And now that they're pausing, this probably has some negative longer term impacts for the city. If you look at housing, which has been, basically going straight up for the last several years because of the expansion of Microsoft and Amazon, housing prices in that region have been up about 11%. And there's a pretty large wage gap in the market there. So you have a lot of these new tech folks that have moved in for Amazon or Microsoft. Housing prices have gone through the roof. You have some really high income earners, but then you have some really low spectrum earners as well. And so we're starting to see just some of that friction play out in the market. And it's a little disheartening here. I mean, we're talking about a lot of square footage flooding the marketplace. It'll be interesting to see what happens over the next 6, 9, 12 months. I mean, I think we've talked about Minneapolis at about 2 million square feet of sublease space. These 500,000 square foot leases add up pretty quick here in Seattle.
Yeah, especially in that Microsoft case, which is now the 4th time that they said we're giving back space there. And I'll bring up a reminder that in these cities, it's not an office market, it's an ecosystem, right? The office market drives housing, to Lonnie's point. It drives multifamily housing. It drives retail like Nike Town. It drives income taxes. So you have to think that the giving back of the space by Microsoft goes hand in hand with those 10,000 layoffs they're talking about, which reduces the amount of foot traffic you have in your city at any time. It impacts your restaurants, your shows, your culture, your income tax base, and all of that can become kind of a vortex, kind of a whirlpool effect where it lowers the quality of life. And just like I root for New York really, really hard, I root for all cities. You want them to see and be vibrant sources of culture and jobs and incomes and wealth creation. Here's hoping that some other industries step up and are able to fill that void that some of the tech companies are creating in Seattle.
So we haven't done this segment in a while. And Haley, you're going to have to cue the engine in Brokers Start Your Engines.
So Lonnie brought up Minneapolis just a moment ago. So 2 great segues from Martha and Lonnie on this. This next story comes from Kelly Boucher of the Minneapolis St. Paul Business Journal. She's somebody we cite frequently. For brokers, it's probably a really interesting thing to keep an eye on. Thomson Reuters is looking to sell its headquarters, and it will be taking new offices in the Minneapolis area. So this is, I guess you would call it a mixed green. On the crabgrass side of things, they're looking for considerably less space in Minneapolis than they currently have. I think they have over 1 million square feet in Eagan. Eagan already has sizable square footage out for sublease from some healthcare firms. So crabgrassy for Eagan, crabgrassy in the fact that they're downsizing considerably. Certainly a green shoot in that they are looking to take several 100,000 square feet in downtown Minneapolis, which has been hard hit by vacancies in recent years. On the absorption side, a little negative. On the brokers creating something, a positive.
And we had a trading alert this week that takes us to Denver.
Yes, we're starting to see things piling up a little bit, just like we had the mall, CMBS purgatory category. The offices are kind of heading in that direction too. January's data revealed that the $277 million Wells Fargo Center had been sent to special servicing. The property contains 1.2 million square feet. The transfer is said to be maturity default related. There's a little complexity to that. The loan was slated to mature in December of 2022, but the borrower had extension options that were exercisable. My guess is that DSCR, NOI, debt yield, et cetera, failed to meet one of the qualifiers to get this loan to be extended, hence the transfer to special servicing. My guess is now they are trying to hammer out a deal that will allow the borrower to extend this term another year. But we've seen this with the Greenway Plaza in Houston. We've seen this with 285 Madison in New York. Loans reaching their maturity date, being cash flow positive, but not enough to earn refinancing dollars, and being pushed into either purgatory or into a situation where they get a negotiated extension. I think that will be a big story for the remainder of 2023.
Yeah, I think we're just now starting to see this play out, but this is going to be the theme, in my opinion, for 2023. I mean, if you look at this particular asset, man, it's 1.71x on the debt service, 83% occupancy. So this isn't an office that by today's standards would be considered struggling. I mean, it's producing positive cash flow, strong debt service, decent occupancy, all things considered. And if they're not able to get refinanced, I think this spells, you got to take that as a negative look on the office market more broadly, because there's a lot of buildings that aren't going to be posting that type of financial performance and or occupancy.
I have a few other stories to cover here. One of the stories that will make it our way into the research piece, one of the loans we're watching, about 10 years ago, State Farm did a big sale leaseback deal where they sold 14 properties, took out a nearly $400 million loan off it, and that loan went into securitization. It has almost, I guess, about a year and a half left to run before it matures. The borrower has the ability to extend for 5 years, but the entirety of the 14 properties backing the loan, the sole tenant is State Farm. Every one of the State Farm leases ends in 2028. And in either every single case or in almost every single case, I'm not sure it's 100% intersection, State Farm has already vacated the property behind the loan. So this is a huge portfolio that was purpose-built for an insurer that doesn't need the space anymore, that sometime in the next 18 months, a decision will have to be made, which is this something that the borrower wants to keep going? Will it pay off? The likelihood is no, and then it goes into its cash managed point of view, and it just goes into a period of extended uncertainty. But to my point before, this is another story that we're noticing years before the loan matures and is a big source of liability for CMBS investors come 2024 to 2028.
And we talked about subleases a lot last week. I think we had a special segment on subleases, and we have another regarding sublease space growing in Columbus.
Yeah, I'll go through that one very, very quickly. And I do want to give two green shoots before we end up. This story here comes from the Columbus Business Journal. It's worth seeing. They spell out an enormous number of subleasing parcels that are available in that city, including one that touches a CMBS loan. But it's worth looking at, and it's of a piece. Right now, we've put out things about Minneapolis, Seattle, San Francisco, New York. The breadth of the subleasing epidemic has really no end. It goes from shore to shore. On the green shoot side, two very quick stories. I like to end on a positive. In San Francisco, the San Francisco Business Journal revealed that Gilead, the firm that makes HIV drugs and drugs that have been really miraculous for those that had hepatitis C, they really eradicated hepatitis C, not just slowed the growth of it, they've really cured it. Gilead is looking to build a 175,000 square foot research center in Foster City, California. That story is by Ron Liuti. I hope I'm pronouncing that correctly. In Atlanta, or I should say in Charlotte, Chime Solutions, which is an outsourcing company, has taken 40,000 square feet of space at the Innovation Park in Charlotte. Great to see them expanding. Chime is Atlanta-based, and recently they put space up for sublease in San Francisco. And lastly, in St. Louis, which is one of the hardest hit markets in the country, Express Scripts signed a 300,000 square foot lease extension. That comes from Gloria Lloyd of the St. Louis Business Journal. That extension allowed the owner of the headquarters to sell the headquarters for $36 million. So a green shoot, both in terms of the firm maintaining its presence in the area and also for an office sales transaction. And that's all I got.
And a programming note, we have a Market Pulse webinar Friday, January 27th. Contact us if you want to learn about how to sign on and register. Our own Lonnie Henry and Stephen Bushbaum will dive into some of the macroeconomic news, analyze the data and the trends that are impacting the market. They're going to cover things like labor market inflation, multifamily, maturities, refinancing risk, and New York's Local Law 97 and what it means for CRE. So if you're interested in any of those topics, it's worth listening in. And a continuation of our future leader announcement. This week, we've got the graduate winners, and by graduate, I mean graduate level work. So students that have finished at least a master's degree. Anna Padron and Kimball Tillman from NYU, Catherine Hahn from Cornell, Jesse Wren and Adam Wecking from University of Wisconsin-Madison. Congratulations. These are students and emerging professionals who are looking to make an impact in CRE and finance after graduation. So we wish them the best. Shout outs. We got a good number of listeners that were interested in the year-end magazine. They also gave us some nice shout outs. Mario H, Jake V is a listener from San Diego. Jody V, hats off for the best podcast in the industry. Mason R, Robbie L, Jessica H, David C, who's a tenant rep out of LA, working with the office asset class, doesn't miss an episode. Patrick L listens every Monday on his commute to work. Happy to report they're back 4 times a week in the office in San Francisco, of all places. So that's good news. Hopefully more green shoots to come. Yamal A, Rachel J, Cameron K, Michael D, Ivan K, Grant C, who has a lot of knowledge in the multifamily space. Ken sent us some feedback on our last podcast with Arrest. He said the podcasts are super. Martha Manis and Lonnie are outstanding. So thank you for making that nice comment. I'll take that.
And I'll throw one more in. Claire, who reached out to me on LinkedIn. Thanks for listening and thanks for the kind words. Really appreciate your listenership.
And Lucius C sent us an article about Cecil. Bill P is interested in cap rate expirations. Bridget C loves the podcast and thinks the content and the pace are outstanding, to keep it up. We had a comment in the CREFC member spotlight newsletter where Ginger R said that the TreppWire podcast is her favorite. And on Twitter, Finance God, always hard to say these Twitter handles, recommended our podcast to others, saying the podcast tops the list for me. And there was a nice little, viral chatter on Twitter about the Veritas multifamily portfolio and Chet-Writ loans. We probably can't cover it in too much detail, but we could give a quick summary.
Yeah, I mean, it's two big loan portfolios. Multifamily, by and large, has avoided any significant distress. I think other than a big loan in Queens and these two big portfolios, delinquencies have been few and far between. We do anticipate more this year because of higher rates and the cap rate issue that we've talked about before. Veritas, big portfolio, B and C level portfolios in the Bay Area. This was once known as the Lemby portfolio, and that, unfortunately, that set of loans once saddled CMBS investors with big losses about 10 years ago. It's been repackaged and occupancy is very low. As far as the Chet-Writ stuff, we started covering this, I think, in 2021. We were pointing out that occupancy and DSCR at this portfolio, which backs a big 2019 deal, was really kind of sucking wind. These are outliers in an otherwise pretty healthy multifamily market over the last 10 years.
And lastly, well, apparently the luxury consumer, guys, is getting younger. All those TikToks that are showing off those posh labels is partly why millennials and Gen Zers are responsible for all the luxury market's growth last year. So, that made me think we need a TikTok trend for the everyman brands. And I'm thinking, Lonnie and Manis, you're the guys to do this. You can pull it off.
Do I have to do a funny dance? Do I have to introduce a new version of the floss? Do I have to show my one pack? What comes with having a TikTok presence? Do I want to have a firm sense of what's involved? Do I have to jump off the top of a garage and land on a horse? Until I know real details, I'm sitting this one out.
Yeah, I think I tried signing up for TikTok one time and it denied me. I don't know what that meant, but I assumed it wasn't for me. So yeah, I don't know. Maybe I'm not your everyman brand man. I don't know.
I
want to see Lonnie in the horse costume built for two. That's that's where I would take that one.
Haley might have to give us some instruction on TikTok later. All right, with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.